Let's cut the intro and dive into the main reason you clicked this video. But first, like and subscribe. Here are 7 stock market mistakes to avoid. 7. Ignoring tax breaks. The golden principle for all the investors experienced and novice is always to take benefit of annual tax wrappers offered by the government. Investing in equity offers various tax exemptions and deductions which you can avail off your stock market investments. A sum of the exemptions and deductions that investors are entitled to in stock instruments, whether they invest indirectly or directly, include: A. No lock-in period when investment is made directly in equity. B. Long-term capital gains are tax-free. C. Investors can offset short-term capital gains against short-term losses. D. Dividends are tax-free. If investors enter into the stock market indirectly by investing in mutual funds, they are again entitled to avail tax exemptions on long-term capital gains. The same rule is applicable for equity-linked savings schemes. However, there is a lock-in period of 3 years in equity-linked savings schemes. 6. Chasing returns. Chasing returns while picking a stock is one of the most common investing mistakes. Never forget that stock movements are cyclical. They follow their own journey of ups and downs. If you invest in a stock or equity because of high returns at a given time period, you might not will land in the right investment. It might be a momentary bull run. You should do a thorough study of the company, its growth objectives, business model, management, and other factors. Many times a company that fails in one or more of these factors may also be seeing high valuations in their stock. Chasing returns is equivalent to blind investing. Investors start their investing career thinking that they can surpass the market performance and get huge returns. They expect their $1,000 investment to turn into $10,000 overnight. However, reality differs from expectations. Investing is about moving step by step towards the set goal, and therefore, investors should separate themselves from gambling. 5. Investing with a trader mindset. If you are looking to make quick gains, then you are not in the right place. This is where the difference between a trader and an investor becomes essential. While a trader engages in buy and sell, an investor focuses on buy and invest. The basic difference between a trader and investor is that an investor must keep a long-term perspective. Expectations of quick gains might not fare well, and it becomes important to differentiate between speculation and investing. Volatility and cyclical movements might scare you if you are a new investor. Markets will always have a share of ups and downs, and they are a part of its cyclical nature. Your money needs to stay invested for a long period of time. Early redemptions are one of the most important investment mistakes to avoid. Preferably, money needs to be invested for at least 7 to 10 years for it to show any returns. Until a company grows, the share price won't grow, and you need time for the company and its stock to grow. If you give in to your irrational fears, your portfolio will go down. You will sell and exit in haste without giving your investments sufficient time to mature and lose the opportunity to create wealth. 4. Getting emotionally invested in a company. A problem occurs when you get emotionally invested in a company and ignore obvious red flags. While buy and hold saying is true, keep your mind open when you see the fundamentals of the company being compromised. So how do you know if the fundamentals are changing? Couple of red flags you can look out for are any sustained underperformance quarter on quarter, if the non-performing assets for banks and other financial institutions are going up, or if there is any sudden or abrupt exit of the senior leadership, etc. If you cannot do it on your own, consult a professional advisory and then make a decision. Always look at organizational factors of a company and do not chase returns. 3. Buying based on recommendations. Often, we turn to our well-meaning friends and folks for advice on important matters in life and finance. However, when it comes to stock investing, banking upon the advice of your friends and buying stocks that they bought is not the best way. This doesn't work because your risk profile and financial objectives may be different from the other person, and what has worked for him may not work for you. So listen to all the information, but conduct your own due diligence about the company and convince yourself thoroughly. Only when you feel your objectives align with that of the company should you go ahead and invest. Also, many at times, we hear people saying that you should follow the trend. The stock market trend should be followed, but this concept is not applicable always. It is not necessary that if the mining sector is doing well today, it will also deliver strong returns tomorrow. This is the biggest mistake that investors make, whether they are novice or experienced. A bullish stock market instills confidence, and more people come into the market as they see the gains others are making. The end result is people end up investing at a time when the market is at peak. It is best to ignore short-term noise and concentrate on individual objectives and longer-term goals. Never make a decision purely based on past performance. The best example is of crude oil, which declined from its peak of over $100 a barrel to $30 a barrel in a very short time. Or GameStop stock, which rose up 5,000% in a span of 3 to 6 months. While this was a good investment, many people lost money, as when the news got out many traders entered and it was at the top, making them lose a lot of money. Remember this Wall Street's proverb, everything is priced in. 2. Not diversifying. Another mistake that investors make is investing a large chunk of their capital in buying only one kind of stock or a single company and then incurring a loss when the portfolio goes down. Even if you look at the publicly declared portfolio of successful stock investors like Warren Buffett, you will see they have stocks across industries and businesses. Diversification spreads out your risk. It makes sure if some stocks are going down, others gain and nullify your loss, so your portfolio remains balanced. As your portfolio expands, so does the requirement to allocate the funds in different asset classes, including commodities, property, shares, and bonds. Investors should choose a global fund as they take the first step in their investing career. They should ensure that their portfolio should not include over 10% in any one fund. Mutual funds offer a convenient way to achieve diversification as they often invest in numerous stocks from different industries. Investors can also spread out their risk even more when they invest in multiple mutual funds with varied investment goals. 1. Emulating a successful stock investor's portfolio. Picture this: you have read about a successful stock investor's story, such as Warren Buffett, and Googled his portfolio. The search results show his portfolio. You decide to buy the shares that are mentioned in his portfolio because surely if he has invested in them and made a name for himself in the stock market, then what's wrong in imitating? This is the most common investing mistakes retail investors make. In order to bypass the research and homework to see the best fit for themselves, they try to copy the portfolio of a successful stock investor and invest in the same companies. This approach is faulty due to the following reasons. 1. You do not know the entry point. Whenever you invest in a company, it is important to know at what level you should invest. When the stocks are listed in the portfolio, you may not know when they were bought or at what price they were bought, and it may or may not make sense for you to buy them at this particular moment. For instance, the person whose portfolio you are trying to copy may have bought the stock when its value is $69 and now its value is $420. So now if you go ahead without thinking and buy it at the same price, you may incur a loss when its value goes down. Needless to say, it's super important to know the right price at which you should enter, the amount of risk you should take, and the right time to exit as well. 2. A mismatch in investor profiles and objectives. It is not necessary that your risk profile and objectives will be in line with the famous investor you are trying to copy. He may have more finances at hand and may have a higher risk profile, meaning he can afford to take more risks and may have invested in a particular stock. You aping his investment will land you in hot soup. He may have invested in a risky stock because he can afford to do that financially. If you copy him, you will lose your money and determination to invest in the future. 3. The entire portfolio may not be public. Whenever a big investor invests in a company, retail investors don't know anything about it till the moment they buy more than 1% shares of the company. When someone's holding in a company becomes more than 1%, it has to be made public. So it's a huge possibility there are multiple stocks in their portfolio that you may never know, and you will have a half-baked portfolio based on incomplete information. Finally, if you're searching on the internet for the portfolio of a famous stock investor, certainly this information is publicly available to other retail investors. Chances are this has led to an increased price of the shares. Needless to say, you aren't doing anything different that would allow you to make more money. So you won't profit in the long run.